In this week's update, a huge shift in what it means for markets, growth versus value stocks, investing in the megatrends, and how to de-risk and still perform strongly. My name is Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. Well, look, so much has happened since last Sunday. Obviously, the news about the vaccine on Monday really triggered a huge shift in the market, and it was really a roller coaster there for a couple of days. The signs are things are starting to settle down and get back to normal towards the end of the week, but it did trigger a very significant sector rotation. So we saw money come out of the stocks that had done really well since the early part of the year when we had the crash in February, March. And that money rotated into the stocks that had been so disadvantaged during that period. So that begs the obvious question: is this just a transient period where we're seeing a sector rotation for a short period of time? And that happens all the time. I mean, that has always been and always will be. There will be periodic times when money flows reverse and goes somewhere else. And it doesn't require a market crash or a significant change as we've seen to do that. So is this just a transient period, or is this something more permanent? And is the incredible bull market in FANG stocks and other high-tech stocks finished, as some media commentators are calling for? Now, I think if you've been watching these videos for a while, you'll have a pretty fair idea what my answer is going to be. But I'm certainly going to back it up with a pretty factual argument. There are so many unknowns still around the vaccine. I mean, as usual, the media seizes on it, and it's sort of game over. We're going back to normal almost instantly. And I think anyone that thinks about that just knows intuitively that that's not going to be the case. There is issues around the longevity of the vaccine. Does it last a month? Does it last 6 months? Does it last a year? There's just not enough data or information to know that. What is the efficacy of the vaccine across different age groups, across different ethnic groups, across all sorts of different demographics? Again, unknown. The logistics is a massive issue. How do you produce sufficient numbers, and we're talking hundreds and hundreds of millions, if not billions of doses of vaccine? How do you package them? How do you transport them? The Pfizer alternative, I understand, has to be transported at minus 70 degrees centigrade. You don't just do that in a cardboard box. So the logistics around that are just extraordinary. And then, of course, if all of that plays out, then what is the economic impact? Is it really positive? Is it mildly positive? Again, no one knows. So whilst it's great news that we've got a vaccine, this is just one step, the first step in a very, very long road. So to think that we're going to get a quick economic recovery is just not at all realistic. So that's the first point that I would want to make. So that in itself tells me that at the moment, all we've got is a bit of a transient rotation, that the stocks that had suffered so badly because of COVID are not suddenly going to go back to normal. Now, the market might price them that way, but as soon as the reality sets in, then those stocks are at risk of having their share prices collapse back again. I'm not saying that will happen, but that is the risk. And I want to talk a lot more about risk in this video as we go through. Okay, now, so that then leads to the question. So we've got a sector rotation going on from growth stocks to value stocks. So that raises the question about where your money should be in the, say, the medium term. Now, I get questions as to why I've been so narrowly focused on the megatrend stocks, the growth stocks, and not interested in possible big bounce backs in, let's call them return to normal stocks like Qantas or Webjet or Woodside, those sort of stocks. And to me, it's about risk and about certainty or near certainty. The first group of stocks, which are the return to normal kind of stocks, Yes, the rebounds might be big and the stocks may appear to be much better value, but what about the uncertainties? And I covered those uncertainties on the previous slide. So how are those stocks going to perform over the medium to longer term given all those uncertainties? And the answer is, I really don't know. So for me, there is still a lot of risk around those stocks. On the other hand, many of the growth stocks are expensive. There's no question about that. And some of them are just far too expensive. And so, we avoid those. But if you select well, and there are just hundreds and hundreds to choose from, where the growth is a near certainty, and you can do that, then they're going to grow into their valuation. So I seek as much certainty about the future as I can get, and megatrend stocks give me that near certainty. The second thing that I need to do to make a lot of money is to make a lot of good decisions and few bad ones. When times get stressful like we've had through the COVID period, you've just got to get into a process where most of your decisions are good, solid ones, and you make a few bad ones, but you keep them to a minimum. Now, I spoke about this last week. It's about having a clear and confident perspective on the market, using the sorts of indicators and relationships that really are valuable, that really are reliable, and that give you a far greater insight and a far more reliable insight into what is really building up in the markets. So they're more a reflection of money flows than anything else. So once you've got that process in place, it's so much easier to develop the discipline that leads to consistent success. So for me, that's how the process works. And it all starts with real clarity about what the market is probably going to do. So let me put a bit more substance to that. So it's about the reliability of future growth and the safety of future growth. So for me, investing in megatrend stocks, the very best megatrend stocks that I can find, is a lot safer than going into some return to normal stock that might be paying a dividend of 7 or 8% because the share price has been smashed, but there's a huge amount of uncertainty. Yes, some of those megatrend stocks can be volatile, but if we're talking about ultimate growth and ultimate safety, then to me that's where it is. So just as an example, and I'm using Microsoft on the one hand as an example of a growth stock. I wouldn't be investing in something like Microsoft because I've got literally hundreds of megatrend growth stocks that are better than Microsoft or Amazon or Facebook. I'm looking for stocks that are where the Microsofts and the Amazons were a decade ago, and I think I've got visibility on a lot of them. But if we compare, say, a Microsoft versus a Qantas or a Webjet, which one would you rather own at this point in time? Which one has the greatest certainty of future growth? Yes, there might be a big bounce back in the share price of Webjet or Woodside, but is it sustainable? Is it just a short-term spike that's not going to be sustained? I don't know. And it comes back to the point, I'm seeking as much certainty as I can get. Now, there quite possibly will be a situation for a little while now where the really expensive stocks see some multiple contraction. So in other words, the PE ratios may come down a little bit, which means that the stock prices may not perform. And we may see a multiple expansion on some of the stocks like Qantas and Webjet, where the market is prepared to give them a higher PE ratio. So I do acknowledge that we will probably see some of that dynamic. But again, to me, that's just transient, it's short term, and if things take as long to get back to economic normal, as I expect that they will, and we're talking, probably several years here, then, I know how it's going to play out. Give me the growth stocks every day of the week. So last week I looked at growth stocks versus value stocks, and we'll have a look at that chart again in just a minute. And I also want to look at another indicator which is really quite valuable, and that's in the US, looking at consumer discretionary stocks versus consumer staples. So consumer discretionary stocks, particularly the online ones, have done really well, and when consumer discretionary stocks are outperforming, then that's an indication of of a fairly bullish market setup. So let's go and look at some of those charts. So first of all, the Nasdaq, and QQQ is the ETF that tracks the Nasdaq. So you can see that we've seen quite a bit of volatility in the Nasdaq because of that rotation that started last Monday, and it's certainly been more volatile than the S&P. But look, it did bounce back towards the end of the week, so it wasn't it looked pretty ugly on Monday, but it certainly did bounce back. But let's look at some of these spreads. So this is growth stocks versus value stocks on the Russell 1000. When the line is rising, so this is one divided by the other. When the line is rising, it means that growth stocks are outperforming the value stocks. And if we pan back in time, you can see that that has been the situation. So I've gone all the way back there almost to 2000. So really since around 2007, growth stocks have done far, far better, which is what you'd expect because technology has made incredible leaps and bounds since that time. Now, there's a bit of a line in the sand for me. It's not a deal breaker if this line went below 1.67, this ratio, but I certainly feel more comfortable if it stays above it. And at this stage, that's what it's doing. That's the reality. So that's an indicator that I'm watching fairly closely. Another one, this is consumer discretionary divided by consumer staples. And again, when the line is rising, you can see what happened to the line during the crash in February, March. The money flowed out of consumer discretionary stocks and briefly flowed into consumer staples. But look how quickly that reversed and got back to normal. From peak to peak, that was the 12th of February. By the 19th of May, that whole crash had played out, and we were back into the normal trend. So again, you can see that yes, there's been some rotation in the last week, but it's still holding up pretty well. Okay, let me just make a few comments about the US election. I think the US election outcome has been a perfect outcome, a perfect balance for the market. I'm not making any political or social judgment there. This is purely as it affects the market. I think you couldn't have scripted a better outcome. The reason being, Biden, I think, will spend bigger than Trump. The Democrats will spend more than the Republicans. I think everyone would probably accept that. Whether he can get that through the Senate is another question. But at least there will be a tendency there to spend more. The other part is that given the overall election outcome, with the Democrats losing a few seats in the House of Reps and not gaining control of the Senate, means that Biden has got ammunition to fight the far left in the Democrats. So Biden is more of a centre positioning politician, and he's got a lot of very far left with policies that frankly scare the market. But he now has the ammunition to fight them off and keep them at bay. And the third thing is that the Republicans with the Senate have now got the power in the Senate to provide the checks and balances that may arise, particularly if Biden steps down before the presidency ends and Kamala Harris, who certainly is more left-leaning, were to take over as president. So that's sort of set up for at least the next couple of years as being a pretty market-friendly kind of Congress. Markets love no surprises and lots of stimulus, and that's what it looks like we're going to get for the next couple of years until the next midterm elections. Bond yields are rising, and I've been talking about this now for a few weeks. Now, bond yields rising means bond prices are falling, so people are selling bonds. So that means money is leaving that market. It means nothing else other than that. There is not some other mysterious force that's pushing yields up. The yields are going up because people are selling bonds. Now, what does that mean for stocks? Well, just in the US bond market alone, the US bond market is around $40 trillion in value. The US stock market is around $20 trillion in value. So the bond market is twice as big as the stock market. And there is something like $700 billion a day gets traded in US bonds. So the liquidity and the size of the bond market is far, far bigger than the stock market. So if money is coming out of the bond market, where do you reckon some of it's going? Where a lot of it's going? It's going into stocks. Some of it's probably going into precious metals and perhaps a few other asset classes, but the vast majority of it is going to go into stocks. And so that's got to be a real positive. Moving on now to the point about how to de-risk and still perform strongly, because I think everyone knows these days that interest rates are absolute rock bottom. They're probably not going to go up for years and years to come. And so the huge issue, the huge social issue, is that retirees who were relying on higher interest rates and higher dividends from stocks have now had that taken away. And so they're being forced to go into the market, which is a market that they don't know, they don't understand, and they're very nervous about it. So I think focusing on how you can de-risk your investing activities, yet still perform strongly to provide the sort of return that that people are looking for. So I think that is a really, really key question. And one of the absolute cornerstones is understanding the key drivers. Those key drivers, they're not going to be on the 6 o'clock news. What do you get on the 6 o'clock news? You get what the S&P did or what the ASX 200 did and a few other, fairly irrelevant comments. You're not going to see those charts that I showed you before to show you where the money flows are going, to show you what the bond market is doing, what the VIX is doing, all those sort of things. You don't see that in mainstream media. So you really need to understand the key drivers. Secondly, you need to narrow your focus to only what works really well. Forget about traditional diversification. That's just not going to cut it these days. We've got an economy and a market in two halves. We've got the real growth stocks and the stocks that are going to be left behind, and some of them are going to become redundant. So forget traditional diversification. You really need to narrow your focus down to what works really well. And yes, you could chance your arm and try to pick the bottom in Woodside or Webjet, but what is the risk around that? To me, that risk is too great, too uncertain. Give me the high growth stocks that have got almost near certainty around that growth. The next thing you got to do is to get a very large list of megatrend stocks. No point in just having 5 or 10, because then you'll be influenced to chase prices. So get a really big list. I've got hundreds and hundreds in both Australia and America of stocks that have a really high probability of doing extremely well over the next 1, 2, 3, 4 years. The next thing is to become accomplished at chart reading. And this is what goes into the output into my memberships. These are the things that I do all day, every day. You've got to become really accomplished at chart reading, and not just at a superficial level, not just looking at moving averages, etc., but really being able to interpret what the price action is telling you. Then you need to be able to clear your mind of bias. So having done a lot of those mechanical things, then we turn to psychology. So we all come with biases, we all come with a level of emotion, and you're never going to completely get rid of it. But the more that you can reduce those biases, those emotional responses, and I think the most important thing is to be open to change. And I get questions and comments from people that clearly are not open to change at all. They are still stuck in their way of thinking that was how they did things 5 years ago. And if that's where you're at, then you're in a lot of trouble, because the world is moving very, very quickly. So you've got to be open to change. You've got to admit quickly that you were wrong and that things have changed and you need to adopt a new stance. It's really critical. And then finally, just building confidence that your process works by disciplined repetition of the process. You know, I keep banging on about having a really coherent process. It's just so important. And then all of that, of course, comes together in cultivating resilience when markets wobble. You know, when we went down in February, March, I felt a bit uncomfortable there, but I didn't lose my confidence about my process. I knew that prices would bounce back because I knew my process was robust. So when markets wobble, you've got to be emotionally resilient enough to deal with that. All right, now I do this almost never, maybe once or twice a year, but I'm just going to do a quick bit of flag waving for Portfolio Analyst service, which is one of the two services that I've got. So it's a once a week stock analysis video. It provides a lot of education, particularly around market perspective and chart reading. There are specific recommendations. There's a lot of fundamental and technical analysis. There is members are asking questions, so there's a lot of Q&A and everyone can learn from everybody else. And honestly, some of the stocks that I've never heard of that are asked about, there's some absolute gems. So it really is a terrific service where you can benefit from the collective eyes. It covers both Australian and US stocks. There are two model portfolios. One is a 10-bagger portfolio, which is a 2 to 5 year project for me, where I'm identifying stocks that I think have got a very good chance of rising anywhere between 5 and 10% over the next period of years. And then there's an enduring growth portfolio as well, which is really bigger cap stocks. They're certainly not going to go up tenfold, but they're ones that I think we can do extremely well out of with a high degree of certainty. There's a lot of premium market commentary, analysis that I go into strategy. It's really everything that I can put on the table that I think is of value. So there's a searchable video library. We'll take a look at that in just a minute. There's over 200 hours of training and analysis. You can look at the analysis of past reviews, and I'll show you how to do that in just a minute. And you can do a demo membership as well, $1 trial for 2 weeks. If you want to continue beyond the 2 weeks, if you like what you see, then it's $99 a month beyond that if you want to continue. And there's the website address for anyone that wants to look into that. So let's just take a look at that aspect. Sorry, that's the wrong one. Oh, just before I move on to that, I'll just show you the VIX index. So this is the VIX. This is over the last 3 months. So here was the big spike. We got a spike in September, went just above 30, didn't last very long, and then we got this big spike just recently up to over 40 around the election. And again, you can see it did mark, once we went over 40, it's a very rare event. It's only happened 9 times in the last 30, 40 years. And it didn't last very long. It did mark a low in the market, and the VIX is now back down to 23. Okay, so here's the Portfolio Analyst site. There is the archives going back to 2017 when the service started. So you'll find there's 48 editions a year. So there's a tremendous amount of learning and education in there. If you want to look at a stock, let's look at one of the 10-bagger stocks, let's say PBH. Then you just put the PBH code in, hit enter, and it gives you all of the videos where PBH was discussed. And then it's just a matter of clicking on that link, takes you straight to the video. There's a timestamp table beneath it. You can find 25.5 minutes is where that started on PointsBet. I talked about it for 3 minutes and 20 seconds. and then you can just take yourself immediately to that spot. So you can zero in on exactly what you want to see. So I think there's an awful lot of value in Portfolio Analyst, and if you haven't taken the trial, then I would certainly recommend it. All right, let's move back on now to the remainder of the market update. The S&P was up another 2.2% for the week, so I think it was 7.3% last week. There was a huge rotation on Monday, as everybody knows, particularly into cyclical stocks, the recovery stocks, but also into small caps as well. You know, the Russell 2000 did really well. One of the features of reporting season now, again, which is a very, very good guide, is that companies are now back raising guidance. They don't have to do that. No one expects them to do it. It's a real sign of confidence in the future. And when you put that together with some other things that I'll talk about on the next slide, it really does paint a very, very bullish picture for stock markets in America. We've now reached a very strong long-term buy signal. We've got new highs now for the Dow Industrials, the Dow Transports, and the Russell 2000. And that the combination of those three just cannot be ignored. It is just such a sign of a very, very positive economy and a very positive market. When industrials are doing well, when transports are transporting things around the country, then you know the economy's doing well. And when the small cap part of the market is being well supported, you know, that is what you see in secular bull markets. Now, the US dollar did make a little bit of ground, jumped up about 0.3 to 92 3/4. And the 10-year yield is inching back up again, up to 0.9%. So let me just look at those charts. So we'll check the S&P first of all. So you can see the S&P pretty much closed at a new all-time closing high. It was almost exactly the same as what we saw on the 2nd of September before we had this last wobble in the market. So basically, all-time closing highs for the S&P, and you know, that really pretty much says it all. And we looked at the triple Q before. Okay, looking at the currency. So there's the US dollar index. So fell on Friday, but net it was up for the week. And just while I'm here, let's look at the Australian market. So that's really just pretty much the inverse of what the American market is doing. All right, and just some other points on the American economy. Most of the data points are highly bullish. You know, if you get away from the mainstream media and whatever particular biased narrative that they're peddling, most of the data points are highly bullish. Unemployment is dropping really, really quickly. It's surprising, surprising everybody. Even the most typically bullish of sort of people are really surprised at how quickly unemployment is coming down. Inventory levels for manufacturing are dropping. Production is struggling to keep up. It's a sign of a very buoyant economy. The housing sector has been really motoring pretty much all year, and it hasn't slowed down at all. And of course, the housing market doing well has a multiplier effect through the economy because, you know, people go out and buy things, buy durable goods, and durable goods orders are going extremely well. Now, if we look at the risk attitude of the market, because when risk attitude is positive, when people are prepared to take on more risk, then that drives stock prices up. And just one of many indicators that you could look at is the spread between high quality corporate debt and low quality corporate debt. So that, you know, the really junk bond kind of stocks. That spread is narrowing. So the difference between the two is getting smaller. And that is a real risk-on kind of attitude. So there's no question that, you know, that people are feeling confident and they're prepared to take risk. And that's good for stock prices. Personally, I don't think there's going to be a going back to the way things were. Yes, a few of the extremes from COVID may shift back, but, you know, we're not going back to the way things were before January of this year. People have gotten used to getting things and doing things cheaper, faster and better. Why would they go back to all the way back to the way they used to be? So I think it's nonsense to suspect that the economy is just going to return to the way it was in January. It's just not going to happen. Turning now to Australian stocks, the Aussie dollar was steady at 72.5, and as I said before, it's really just following the leader, following the US dollar. Our market gained a further 3.5% on the week, but it had underperformed the previous week against the US. And small caps in Australia continue to bounce back really hard. There's some sensational moves in the last couple of weeks in Australian small caps. To me, the general market, so just looking across the entire market and having a diversified portfolio, is not a safe place to be invested, and it's not a good place to be invested. You're not going to get anywhere near the returns. Now, I know that a lot of stocks in Australia are super expensive, and I wouldn't be buying an Afterpay Touch at this level. I think it's far, far too risky. But there are a huge number of high growth, mega trend kind of stocks that are not at those extremes and that are going to do extremely well. So for me, the best advice I can give you is to focus on companies that are innovative in all sorts of areas, in industrial processes, in healthcare, in biochemistry, in fintech. There's many different avenues. If you focus on innovation and you pick the best companies that you can find, the best managed companies you can find, then I think you're going to be on pretty good ground. Okay, just checking quickly on the ASX 200. So we do have a breakout on the index for what it's worth, but look, frankly, I just don't pay much attention to it. This is probably the only time of the week when I do this review that I would even look at the ASX 200. My focus is on individual stocks, no question. Turning to precious metals, this is gold. We'll look at gold first of all on a daily. So we're still in this overall range and we're just bouncing up and down, but we're sustaining it above the 200-day moving average. Now we've come back closer. So the big plunge that we saw on Monday as a consequence of the vaccine. So what happened there was a certain amount of fear in the gold price due to the uncertainty of COVID. As soon as the vaccine gets announced, even though there's a heck of a long way to go yet, the fear factor came out of gold. But look, that's only one driver of gold. There's lots and lots of other drivers for gold, and they're all positive. So I'm still very bullish about gold in the longer term. But as you know, I've been looking for a pullback to, a wash out, get rid of the excess that built up here in August. We had a tremendous run, ran from $1,740 up to over $2,000 an ounce. That had to get washed out. Normally it gets washed out with a more sudden pullback to the 200-day moving average and sometimes overshooting. This time it's really gone more sideways than anything. But one way or the other, whether it's a big percentage move down or whether it's time, that excess has to get washed out. And I still don't think we're quite there yet, but we're certainly getting there. So if we look on the weekly, you can see we're still in this overall consolidation. And just checking in on silver. Silver actually doing slightly better than gold in the last week as well. So gold down to basically exactly reversed last week's gain. We gained $63 last week or the week before, and we went down 63 last week to 18.90. There is a long-term bull market is building. Bull markets last for 5 to 10 years typically in gold. We're in the early stages. We're only probably 1 to 2 years in. There is a long-term bull market is building. And I think we'll start to see some more positive progress fairly soon. For me, the one of a couple of things that are sort of putting me off a little bit is that the positioning in the futures market, the gold futures market, is still too bullish. I want to see a bit of fear in the futures market, a bit more selling. So that's why I still think we could see a bit of volatility and a bit of disruption in gold. Looking at precious metal stocks, if you look at GDX, which is the global ETF, it's actually being held back because the results from stocks like Barrick and Newmont are actually lagging. So that's holding GDX back. So for me, there's far better performance in mid-tier producers. Plus, also with the mid-tier producers and smaller stocks, takeover activity is ramping up. There's no question about that. And a level of takeover activity looks absolutely assured in precious metals. But it's probably not quite yet. It might only be a matter of weeks, but I still think we need to see a little bit more volatility yet. So that's precious metals. Turning to other commodities, copper was unchanged. Crude oil sharply higher on the vaccine news, but again, I think it's too premature. We've taken one step in a pathway that might have 100 steps in it. So way too soon for people to be getting bullish on crude oil. There was a big jump in oil stocks, on Monday, but there's been no follow through, and I think that's the key thing. If this really was going to be a serious change in the rotation of money flows, we would have seen some follow through, and we didn't get it. Now, let me just show you that chart. So this is XLE. So this is the energy sector ETF in America. So yes, we got a big jump on Monday, but then effectively nothing. If you want to look at a specific stock, look at Woodside in Australia. Yes, we got a jump on Monday and Tuesday. Most of the jump occurred in that period, and then effectively nothing. So I think it's far too premature to be looking at those sorts of stocks. And then in addition, you look at companies like ExxonMobil, for instance. They've just done a massive asset write-down. I mean, this is a sector where a lot of companies are on the verge of bankruptcy. Why would you want to be trying to pick bottoms in stocks like that? It's just too risky in my view. There's the spot copper chart, so unchanged there. And just to wrap things up, the likely pathway to Christmas, and again, I don't do predictions, I just do probabilities, and I look at the indicators and I just make an assessment of where I think the probabilities will be. I think that we're likely to see growth and value stocks in some sort of rough balance. I don't expect we're suddenly going to see all the money just reverse back and go back into growth stocks again. Now, that won't stop some of them rising and rising strongly, and even through the last week. I mean, personally, in my portfolio, I had some stocks in the US that went up massively, even though there was this huge rotation going on. So some stocks can still go up. But I think on balance, we're probably going to see growth and value stocks in some sort of rough balance, neither outperforming the other. So I think if you only buy the very best of each, then you're going to be on pretty good ground. So getting a combination of momentum, so stocks that are moving now, you can see it, there's no question about it, they're trending strongly. So have some of that in your portfolio. But also have some stocks that maybe aren't trending right at the moment, but the fundamentals are so strong and the upside is so great that you've really just got to have them in your portfolio, particularly in a space like, let's say, the pharmaceutical area, where an announcement can cause share price gains, just to gap massively. So you really need to be in those stocks before that announcement happens. So if you've got a combination of those two things, then I think you're on pretty good ground. Portfolio Analyst next week. I showed you what you're going to see there in terms of the Portfolio Analyst service. So I would recommend that trial for anyone that's not taken it. And just to wrap up, my thought for the week, and this really comes from a lot of the questions that I get from people that clearly only seize on the information that suits their narrative, the bias that they've got in their mind. The rewards go to those who embrace all the information. Take it all in, be open-minded, And if you do that, then you're going to be a much better trader and investor than otherwise. So that's it for this week. There's my website, which contains a lot of information about what we do. And there's my email address as well. So that's it for this week. I'll be back with you next Sunday. Cheers.